In the meantime, Michael Vogelzang is president and CIO of Boston Advisors. He manages about $1.8 billion. He's joining us from Boston. And, of course, as promised, Fred Cannon, still with us, Director of Research over KBW, the #1 ranked bank investment team by Bloomberg Markets Magazine. So, Michael, let me bring you in right off the bat. And I got to ask you, you've just upped your equity allocation within your $1.8 billion fund. Is this based on cheap valuation, or do you actually think the world is improving out there?
We think the world at the margin is improving. We think there's a lot of bad news that's been priced in. We think the sentiment has gotten overly negative. This is probably 3 weeks ago or so we began to really change our tune. What's interesting is we're focusing specifically on the U.S. We think the U.S. is a not just marginally but significantly better place for capital to be treated over the next number of years, year or two, and as a result, our equity exposure is increasing in the U.S. specifically.
Michael, I enjoyed your piece today. It was a very simple one, looking at the comparisons between today and a time that was, what, 4,909 days ago, I think is the number you cite. I'm talking about April 1998. A lot of things have changed, but not the S&P, sadly.
Yeah, you know, that's my quarterly piece. The S&P last hit the same closing price on September 30th. Before that, the first time it hit that same level was April 22, 1998 or something like that. So we've basically been 13 and a half years of going nowhere. The only thing that's gone up, of course, is corporate profits. So we're trading at less than half the multiple and all the rest. I mean, earnings, valuations are reasonable. I don't think they're cheap. They're not 1979, 1981 kind of cheap, but they're certainly less expensive. And I don't think we feel like we're paying up for stocks any longer. I think it's a reasonable valuation. The story, however, is we really believe that the U.S. is a superior place to invest. We think that given our banking system problems of 08 and 09, we've sort of gotten those behind us. The housing bubble has been burst. We're now sort of reasonable prices in homes and housing, sort of a reasonable place to invest. We think that corporate earnings continue to improve, and certainly if you do a differential analysis compared to some other areas in the globe, the biggest thing we have going for us, frankly, folks, is we have both an independent Fed and setting fiscal policy. And as dysfunctional as our political system is at times, the fact is we still own both of those pieces. And as long as you own your own printing press at the Fed and you own your own treasury, you're not going to end up defaulting your currency. And I think some of those strengths are really, really powerful. We think Wall Street sort of, and investors in general around the globe, are beginning to realize that the U.S. Has a lot of hidden strengths that so far haven't been priced in.
Hey, Fred Cannon, you run, again, the top-ranked banking investment team by Bloomberg's magazine, Top Rank. What's your view and what's your team's view on the job that the Fed is doing right now?
We're in the same camp as what Michael just said. The fact that the Fed is independent, that we have our own currency, is critical, especially when we look over at Europe right now. I think the Fed's in pretty good shape right now. Obviously, down the road, they have to get rid of all those excess reserves. But right now, it feels like they've done the right thing. We're hoping that they stay on hold and don't come back in with another quantitative easing. We think enough is enough, especially for the financial system in the U.S. The U.S. economy is healing. We've got some pretty good numbers today. And more important in our view is the U.S. economy is looking very resilient. No, it's not growing fast, but we got through that noise with Congress. Despite the European problems, the U.S. economy seems quite resilient right now.
Ask a question about the notion or the theme of history repeating itself. We just had John Taylor on, and some people have taken this far beyond 13 and a half years, going back to the 1930s, suggesting we are at risk of a global depression. Is that something that either one of you are factoring into your outlook for 2012 or your 5-year outlook at this point?
It's not something we're looking at right now. And I'm guessing Michael isn't either.
Michael? No, I don't think so. I mean, but the problem is we're certainly not. The problem is the total and complete dysfunction politically and fiscally in Europe. And we're hoping that the best outcome in Europe is simply getting them off the ICU, getting them out of the ICU, the intensive care unit, and turning them into a chronic low-grade fever that's going to constantly, we're going to be living with the European debt problem for a long time, probably 4, 5, 6 years, maybe longer. And if that's the case, all we can hope is that every time they play brinksmanship, every time somebody says we're not going to move any further, the markets will suffer some small, brief panic, and then the participants will be sort of forced to actually take some more medicine. So we hope that's the outcome. We think if that's the case, the U.S. can avoid recession and in fact begin to grow again. We think the emerging markets will begin to grow again more strongly, and we think global economic vitality will return.
One thing I'd like to add to that is I think if you look at the shape of the U.S. economy today versus either 2007 or the 1930s, very different. The Fed's done a lot. Capital levels at banks are record levels. The liquidity in the system. We had negative reserves in the banking system when we went into the financial crisis. We have $1.6 trillion of excess reserves today.
Why isn't anyone going in and buying the banks en masse at this point, right? I hear this time and time again that our banks are actually quite healthy, and so where our banks go, so it seems the rest of the country does. But why isn't anyone going in and buying banks at this point?
People are scared of the big banks for a good reason, and that is when we came out of the crisis, folks recapped them, gave them a lot of capital based on expected earnings, and those expected earnings have been dashed. If you look back at Bank of America, for example, they raised a lot of capital, about $10, with $2 expected in earnings or more. Now they'll be lucky to earn $1, and the stock's at $5. So really, it's that pressure on earnings at the banks and expected ability to earn under a high regulation, high capital, and a very tough yield curve environment that has people still skittish.
Hey, Michael, what are you doing with the banks?
Well, the only thing I'd add to that is we're certainly underweight bank positions in all of our portfolios, our traditional equity, and also our others. I think the trigger point for us is going to be real revenue growth at the banks, not taking back into reserves, formerly bad debts. We need to see some real revenue growth, and so far we haven't seen it. And until you get that, you're not going to get sustainable earnings growth. And until you get that, the banks are going to stay about where they are. So we're just watching for that.
Hey, we've got some breaking news here. It looks like Fitch is cutting the international depository receipts for a number of banks, Bank of America, Barclays, Goldman. Fred, here you are right now to talk about that. Can you help us understand what that means?
Well, we have to take a look at the report. It's right off the wires. But in general, again, it gets back to the big international banks, those with that counterparty exposure, and those receipts that are pledged as collateral. That's the concern. It's the collateral that they post for a lot of the trading globally.
And that's what you were talking about earlier when you said there are 5 U.S. banks with considerable exposure to Europe. This is what you're talking about,
exactly.
Isn't it?
And the exposures are very difficult to get a handle on because they're relative, that they're big trading books across the continent, and it's that huge notional derivative amount for those big 5 that has people a little skittish.
All right, Fred Cannon, who leads the research group over at KBW, thanks for joining us. Michael Vogelzang, founder of Boston Advisors up in Boston. Michael, great as always to have you. Thank you for joining us.